Consolidated Financial Statements. Consolidated Financial Statements, CFS, are essential for presenting the financial position and performance of a group of companies as if they were a single economic entity. This ensures transparency, comparability, and accurate representation of group financials for investors and stakeholders. This section will cover what consolidated financial statements are and why they are needed, key IFRS standards related to consolidation, the process of preparing consolidated financial statements. 1. What are consolidated financial statements? A parent company may control one or more subsidiary companies. Instead of reporting separate financials for each entity, consolidation combines all financial statements into one report to show the overall financial position of the group. Purpose of consolidation: reflect economic reality, presents the group as a single entity, enhance comparability, allows investors to assess the overall health of the business, prevent manipulation, eliminates artificial profits from internal transactions. Example: if Company A, parent, owns Company B, subsidiary, consolidated financial statements will combine their financials as if they were a single entity. 2. Key IFRS standards for consolidation. IFRS 10, Consolidated Financial Statements. IFRS 10 provides guidelines for when and how to consolidate subsidiaries. Definition of control: IFRS 10, a parent must consolidate a subsidiary if it has control, which exists when power over the investee, ability to direct activities, exposure to variable returns, profits or losses, ability to influence returns through decision-making power. Even if a parent owns less than 50% of shares, it may still have control if it influences key decisions. IFRS 3, Business Combinations. IFRS 3 applies when a company acquires another business. The key steps include identifying the acquirer and the acquisition date, measuring fair value of assets and liabilities, recognizing goodwill if purchase price exceeds net assets acquired. Goodwill represents the premium paid for a business over its net asset value and is tested for impairment under IAS 36. See IAS 28, Investments in Associates and Joint Ventures. When a company has significant influence, typically 20 to 50% ownership, over another entity, it does not consolidate, but instead applies the equity method, where the investment is initially recorded at cost. The parent recognizes its share of the associate's profits or losses in the income statement. This method differs from full consolidation because the associate remains a separate entity. 3. The consolidation process. Step 1. Combine financial statements. Add together the parent's and subsidiaries' assets, liabilities, income, and expenses. Step 2. Eliminate intercompany balances. Remove transactions within the group, such as sales between the parent and subsidiary. Example: if the parent sells goods to the subsidiary, revenue and cost of sales must be removed, as they are internal. Step 3. Calculate non-controlling interest, NCI. If the parent owns less than 100% of a subsidiary, the portion not owned is recorded as NCI in equity. Formula: NCI equals subsidiaries' net assets times percent not owned by parent. Step 4. Recognize goodwill or bargain purchase gain. Goodwill formula: goodwill equals purchase price, fair value of net assets acquired. If the purchase price is less than the fair value of net assets, a bargain purchase gain is recognized. 4. Impact of consolidation on financial statements. Statement of Financial Position, SOFP. All subsidiary assets and liabilities are included. NCI is shown as a separate component of equity. Goodwill is included as an intangible asset. Statement of Profit or Loss, SPL. The group's total revenue and expenses are combined. NCI's share of profit is deducted at the end. Intercompany sales and expenses are eliminated. Statement of Cash Flows, SCF. Cash flows between group entities are removed. Acquisition of a subsidiary is reported under investing activities. Test your knowledge. Multiple choice questions. Q1. According to IFRS 10, when should a parent consolidate a subsidiary? A. When it owns more than 50% of the shares. B. When it has control over the subsidiary's key activities. C. When it provides significant financing to the subsidiary. D. When it has a contractual agreement with the subsidiary. Q2. How is goodwill calculated under IFRS 3? A. Purchase price plus fair value of net assets acquired. B. Purchase price, fair value of net assets acquired. C. Fair value of net assets acquired, purchase price. D. Fair value of subsidiaries' liabilities, net assets. Q3. What does non-controlling interest, NCI, represent? A. The portion of the subsidiary not owned by the parent. B. The parent's share of the subsidiary's profits. C. The parent's obligation to its creditors. D. The total consolidated profit after tax. Leave your answers in the comments. Did you get them right? Let us know in the comments. Like this video if you found it helpful and subscribe for more ACCA, IFRS, and financial reporting content.